Hey guys, it's that Dividend Guy coming at you with another Robinhood portfolio update. Happy Monday. Hopefully everybody's having a GGD, a great green day in the market. You know I always wish the best for my viewers and subscribers. So guys, today we're going to go over the overall portfolio metrics. We're going to go over the buying power, why it went up so high, where I got the money from. Then we're going to look at the individual companies and how they're performing and the deals we have within the portfolio. And then, of course, we're going to look at our buying opportunities or stocks that are on my watch list that I do want to add eventually at the right price. So, jumping right in for today, we are up about $140, give or take, about 2.8 or 3.3%. For the week, we are up $1,387.82, or 2.8% for the past week. The 1 month mark, we are still down $348, or about 0.7%. The 3 month mark, we are only down $195.18, down about 0.4%. Year to date, we are down $195.18. Wow, it's the same, or 0.38%. The 1 year mark, we are down $2,385.54, or 4.5%. So we are down still a little bit over the past year, but guys, that is the name of the game. That's honestly good. I want to be down because that means that there are deals on the market. And then, of course, all time we are up $14,986.19, or we have an all-time return of 42+%. That is awesome. So right now we're sitting at $50,593.54. Then we have a buying power currently of $128.58. So guys, we did get paid by T. Rowe Price. That was $122. And then we just got a dividend today from Coca-Cola for $4.60 because of our 10 shares. So what I'm going to do with this buying power is I'm going to wait for now until Altria pays me, which is at the end of this month. We'll go through and see that dividend when we go through the individual holdings, but that's going to be about $297. So altogether, we're going to have about $330 to play with, and depending on what stock is down the furthest, I'm guessing it's still going to be T. Rowe Price because that's been the current trend. But if it is not, let's say Apple drops 20%, I'm going to put it into Apple. But right now, the goal is to build up Coca-Cola to 100 shares. Right now, money's a little tight because I'm still getting started at my new job. But the dividends are still going to be flowing in, guys. That is the beauty of dividend growth investing, is that even when I don't have the extra capital to be, putting in, the portfolio is still going to grow, right? So we still have growth in appreciation of the stock prices. They're going up over time. And you have the dividends that get paid to you every month, and the dividend itself grows as well at a certain rate. So that's the best part, is you have two growth drivers. You have the stock moving and you have that dividend growth. So that's really the beauty of it. So the buying power is going to be about, like I said, probably about close to $400, a little over $400. So I'll probably be putting that into T. Rowe Price and getting close to probably 4 shares. But jumping right in, guys, to Realty Income sitting at $62. We have 143 shares. I did buy 2 shares of Realty Income with the AbbVie dividend, so that was cool. But we have right about $9,000 of market value. Average cost is right around $67 per share. Almost 18% of the portfolio is in Realty Income. We're down $64 today. Total, we're down $604, down 6.3%. So still a pretty good buying opportunity here for Realty Income, and I would be adding shares if I had the extra capital currently. Next, we've got Coca-Cola sitting at $62.40. 10 shares, $624 worth of market value. Average cost is right around $61 per share. So at $62.40, it's close to my average cost, but I won't be averaging up. I only want to average down. So Coca-Cola right now is not a buy for me. Only 1.2% of the portfolio is in Coca-Cola. Speaking of which, I'm sipping on one right now. But today we are up $3.70. Total, we're up nearly $16. Up about 2.5%. Then we've got Altria. This is the big payer for the first set of months. 315 shares, $14,000 worth of market value. Average cost is right around 47.40. 28% of the portfolio is in Altria, so almost a third of my money is in this stock. Today we're up a little over $150. Total we're down about $700, down about 4.7% on Altria. But as you guys can see, there is a dividend of about it's $196. But that will be paid to us on April 28th. And the plan for right now is to set it and forget it for the current buying power and add that $296 to my buying power as of right now. That'd be around $400. And I'll be allocating that to, I think, T. Rowe Price. Then we've got Apple at $166, so that's up $1.20 today. One share, so of course we're at $166 since we only have one share. Our average cost, though, is $132.66, so 0.33% of the portfolio is in Apple. Very small position, but I will be building it up over time as the opportunities allow, which, I mean, it's Apple, so the opportunities are going to be few and far between, but when they are there, I do want to take advantage. So today we made $1 in the market. Total, we've made $33, or a 25% return on our one single share of Apple. Then we've got AbbVie at $160. Currently, we have 95 shares is our current count with $15,000 worth of market value. Average cost is right around $95 per share. 30% of the portfolio is in AbbVie, so a third of my money is in both Altria and in AbbVie. So very, very big positions here. Today we're up almost $100. In total, we're up nearly $6,200, or almost 68.5%, but almost a 70% return. If you factor in dividends as well into that overall return, I've definitely made 70% on this investment with the stock appreciation. Gotta love that, guys. That's a really good return. And the reason that I love AbbVie so much is because this was a Warren Buffett play, essentially. This was a company that had a moment of weakness. I bought in big, and the bet paid off. Well, the value investing paid off, but it was a long-term holding in my opinion, and I just kind of set it and forget it. I saw the long-term growth of the company. I thought that the current price that it was at was below the intrinsic value of the company based upon the cash flows that Humira and other drugs in the pipeline had. Plus, they were acquiring another company that had very strong cash flows as well. So together, I felt like it'd be an even better business because you're bringing in more cash flow. It's not always that way with acquisitions. Like the AT&T acquisition of Time Warner first was DirecTV, which was terrible, and then Warner was just spun off as well. So acquisitions don't always play out like the Microsoft and Activision one that's going on and has been for a while. I don't know if that's going to be finalized, but they're not always pretty. Like sometimes a company goes out of its wheelhouse, and like with AT&T, they thought there'd be synergy between telecom and the big screen, which there really wasn't, and they paid for it. So, acquisitions don't always turn out the best, but it does seem like AbbVie made a really good strategic acquisition, and I'm benefiting off of it, which is great. So that easily could have gone the other way. It could have been like I did buy into AT&T when Warner Media was purchased by them, and that was kind of the opposite. They bought the company and the stock didn't appreciate at all. The dividend didn't appreciate, any more than it would have before those cash flows. So it didn't really benefit that business. And then it was such a headache. Like they got the streaming service up and running. They got their, they got the assets cash flowing, and then they just decided to spin it off. So not every acquisition is going to work out pretty. Sometimes they get nasty because the companies, the businesses just don't have any synergy together. But AbbVie was buying another pharmaceutical, so it was within their wheelhouse, within their circle of competence. And that's the thing, guys. When you're looking at companies, let's say I did a lot of research on AbbVie, so I felt comfortable putting my money in it. But something that I wouldn't is some small pharmaceutical company that's doing therapeutic drugs or something. I don't even know. It's ticker symbol ABZ, right? Or XYZ. It doesn't really matter. But I'm not going to put my money in something I don't understand. So if somebody gives me a random stock tip, I'm not going to listen to it. The reason that because honestly, AbbVie was outside of my wheelhouse, right? So what I usually do is if there's a stock that I feel like is a deep value and I can analyze it, because I analyzed Abbott Labs because that's where AbbVie spun off of, or spun out of. So they were assets taken from Abbott Labs, and now AbbVie is its own separate company, and now AbbVie had an acquisition and bought another company. So you want to find you want to find a company or companies that invest smart, right? So this was a smart acquisition. They don't always work out that way. So it's important when you're looking at companies to really pay attention to what they do with their free cash flow, because if say like Coca-Cola wants to buy another brand or pay you a dividend, if that company doesn't work out, if that acquisition doesn't work out, they waste the money that they could have paid you. So that is really important, is like when you yourself are looking at companies, you want to make sure that if a company has a history of bad bets, like AT&T really did, and Wells Fargo did as well, they kind of screwed up in the banking sector. They had a lot of bad headlines. If you had your money in it, sometimes a cost down average opportunity really is a value trap, which is what happened with Wells Fargo. Like, even if you made money on it, they still had bad business practices. So just keep that in mind, guys. When you're looking at investments, when you're looking at businesses, of course, make sure you can understand the business. But another thing that's really important that I feel like not a lot of people talk about is the management. And the competency of management is so important because, again, you want the business to stay healthy. So you want enough cash flow within the business to keep it running or make it more profitable, right? You want the business to grow because that's where your money's coming from, is the business and the cash flows that it generates. So you want the company to be healthy enough to grow, and then you want it to be mature enough to be able to pay you money, but which is the distribution of a dividend. But you don't want that to slow down the growth, or you don't want them to spend money and waste it on an acquisition or stock buybacks or whatever they may spend their free cash on. That's going to hurt you. Because here's the thing, in the long run, like say with AT&T shareholders, maybe when the Time Warner acquisition happened, people were like, oh, it's great, there's going to be so much synergy. Same with DirecTV, it's a cash cow, like it's free, it's bringing up all this free cash flow. We're going to be they said they're going to be profitable in like 3 to 4 years. That did not happen. They were really down in the dumps when it came to that cash. They wanted the business because of the cash flow, but then it wasn't cash flow positive because it was losing customers. So they were technically milking DirecTV for anything, as much profit as they could get out of it, because people are cutting cords and it's, the industry's going a different way. And so they wasted money on that acquisition, which then, here's the thing, when AT&T did that, so they wasted money on DirecTV, they wasted money on Warner, which they had to pay up for, and then they ended up having to spin out or sell pieces of those businesses, which then made them have to cut the dividends. So competency in management, guys, is so important, and I feel like that's something that gets overlooked a lot when you look into a company. You want that management to treat your money how you treat your money. And so that's one of the things that really drove me towards AbbVie, was because the management was competent in Abbott and ran it very well. And then the spinoff was great too with AbbVie, and they'd grown the dividend and were very profitable. But at the same time, they could have spent all that money on Allergen or Allergan, however you want to say it, and it could have been a bust. Like it could have been terrible. So I saw it at a discount. I felt like the companies had good synergy because it was within their wheelhouse. They felt confident about it. I analyzed the company that they were acquiring. They own Botox and a couple of other big name drugs. But it worked out. And so just keep in mind, guys, when you're looking at companies, make sure, you would agree with the decisions they make about their free cash flow. So like with AT&T, they said that the dividend wasn't sustainable. Well, it technically was, but you spent, if they had all the money that they spent on DirecTV and Warner, it would have been more sustainable. If they would have just been a pure telecom play, and I mean, DirecTV was really just, they just poured money into that and it was terrible. But I think Warner could have been a good plan if it was executed properly and if they maneuvered it better. But I don't think that was a good, competent move by management. So just keep in mind, guys, when you're looking at companies, always when you're analyzing and looking at the history of acquisitions and like how much free cash flow they have versus debt, just keep in mind that the competency of management is just as important as the business itself, because and at any point in time, an idiot can run a business. Like you can have, you can make poor decisions in management, and even a good business with a bad manager is going to struggle. So I learned that lesson the hard way, guys. I bought AT&T, I bought Wells Fargo when that was going on, and it bit me. So I'm happy AbbVie worked out. Next up, we've got T. Rowe Price, and guys, this is the one that I said I want to be pouring money into because it is down so far. So I bought it at 122. 52-week high is 157. So I had about $36, give or take. Say $30 of upside per share. So on a 10,000, or I think at 2,100 it'd be like 12. Yeah, about 12 on a $12,000 investment. I'm down right now, but I had an upside of $3,000. So I had like a 25% return or 22% return overall, right? Now it's even higher because I can buy it at a lower price. So that's why I want to put all of my dividends and put any free cash I can into T. Rowe Price right now. Because to be honest with you guys, I think it could be as good of a play as AbbVie was, because the management is phenomenal. The thing that I do like, it's kind of the same with T. Rowe Price as I felt with oil. So like with Exxon, when I bought that, I owned that for a while. But I know that oil fluctuates, right? And I wanted to be, and that's why I bought it, was because I wanted that fluctuation. Same with T. Rowe Price. So like when we were on a bull market for 10 plus years, it fluctuated, but it didn't fluctuate that much. But as you guys can see here, this is like the top of the market, right? And so this is COVID, but then it peaked way up, and then the banking sector just kind of took a shit. So this is a good buying opportunity. And so I want to get in as much as I can, because the lower I buy it, the higher potential returns. Plus, on top of the stock price, I have that growing dividend. And so I have both of those working for me and pushing up my returns. So I'm going to be pouring as much money as I can into T. Rowe Price. Hopefully that 11,000 is around 11,500 by the end of next month. Then, of course, we have my two stocks that are on the watch list, which are Visa and Berkshire Hathaway. Guys, I'm so excited. I'm going to the meeting. I'll talk about that in a minute. But Visa's up today. I said I wanted it at 190. It's going up. So I'm not touching Visa with a 10-foot pole right now. But then we've got Berkshire, which is 310. I'm interested to see what the stock does around the Berkshire meeting. So I don't know. I haven't looked that far in the past about like what the stock does during the Berkshire meeting. It'd be interesting to see if there's a correlation pattern, because they make a crap ton of money specifically on that weekend. Like they outsell every furniture store in the country that weekend. So they rake in money during the Berkshire Hathaway annual meeting. So it'll be interesting to see what the stock does. I said I wanted it around, what was it, like I said about $300. So right now I have about $40 of upside on the stock. I don't plan on ever selling it once I own it. So I just wanted it at a decent price. Honestly, with this one, since it does not pay a dividend, my yield doesn't change, right? So if I buy it at 310 and I get a 3% yield, and then it drops to $300, I have like a 3.1 or 3.2% yield. I don't have that. So I'm just going to cost down average, because it's technically a growth stock, right? But still buy low. But I don't plan on selling Berkshire. So I wanted around that $300 mark. But to be honest with you, if it's an initiating position, the price doesn't really matter to me, because I can always take advantage when it goes down. Specifically, the reason that I don't want to buy a dividend stock, sorry guys, girlfriend texted me, but the reason I don't do that with dividend stocks, guys, I don't buy it at any price, is because I have a yield locked in on something like, say, like I'll go to T. Rowe Price, right? But we'll look real quick, because the yield right now on T. Rowe is going to be higher than my personal yield, because the stock is down. So right now it's 4.2%. So say my yield rate is like 3.5, right? And I have that locked in. So if I buy more, that yield goes down. So I'm paying more money for less dividend, essentially. I get a lower rate of return on that dividend and on that dividend growth as well. So I want to lock in a higher yield. But with Berkshire specifically, I don't. I care about the price, but the initial price I don't mind as much. I still ballpark it, because there's a price that I think intrinsically it makes sense to buy at, but it's honestly, I want to own it just because I love Berkshire. I know the business. I know a lot of the business. I don't know all of them, but they own like 70 different subsidiaries. I know like most of their stock portfolio or stocks that I'm pretty familiar with. But really, guys, when I'm buying Berkshire, I'm honestly the first thing is I'm buying See's Candy. I fucking love See's Candy. Um, if I could buy that business outright, it produces so much cash flow for Berkshire. It's ridiculous because there's not a competent way to put money into See's Candy and make it grow and expand. They've tried and it hasn't been profitable. So that's just like I said with AT&T, they tried to do too much and tried to get into different lanes, and now they're back to being a pure telecom. That's the thing when you have competent management. Like Berkshire is very competent with what they do and don't know. So they're not going to put more money into See's Candy than makes sense because then they're going to lose money, right? So they're only going to put money where it makes sense and where it's going to make more profit for the shareholders. And that's why I want to own Berkshire, is because they make decisions like that. They don't say we have 120, or I think it's like 130 or something $billion. They could buy like Walgreens. I saw like a list of companies. But they could buy like 5 or 6 companies with that amount of money, right? But if it's not on there, I think it'd be cool if they own, like, I know Walgreens was on the list, and I think like Dollar Tree or something was on there too, but Disney was also on that list. So they could outright buy companies, but the reason I love them so much is because if they don't understand it, they don't put their money in it. And I feel like a lot of people, like if you give them a stock tip, they're just going to buy it right away, right? They don't even care. Like XYZ company, it doesn't matter. It could be a brick company, it could be Tesla, it could be a motor vehicle company, it could be an airline. It doesn't matter. If you say, hey Jimmy, put $500 in Southwest Airlines, they're going to be like, okay, cool, it's got to be a good stock. He's talking about it, right? But like I said earlier, you want competent management. I want my managers, the company. So when I put my money into a company, I want those people, those managers, to make decisions that correlate with what I would make. I want my money to go to make money in a way that I understand. And I want it to make smart decisions. I want them to make smart decisions with my money, right? If I wanted an idiot to run my portfolio, I'd give it to some random person, right? I'd gamble it. I'd go to Vegas and spend it all, right? So I want to make competent, well-informed decisions with my money, and I expect the managers I expect the managers to do the same. So I am excited for the Berkshire meeting, guys. We did get signed up. We're gonna go. I believe it's in May. I believe it's the first weekend in May, but I'll keep you guys posted on that. But yeah, guys, I am so excited. But I'll wrap it up there. I know it's a little bit longer of a video. I know I kind of went on a longer rant about AbbVie than I usually do, but it is cool to kind of get compare and contrast about what could have happened, because they could have easily made a bad decision, but it did play out in my favor. So, and it's compounding for me. It's been compounding for like 2-3 years now, so I'm happy with that. But with all that being said, guys, thank you so much for watching. Sorry, I know went on a little bit more of a rant today, but I have fun with it. So, thank you guys so much for watching. Remember to hit the subscribe button on my channel, That Dividend Guy. Guys, we've been getting subscribers a lot lately, and it's pumping me up. It makes me so excited to see that number grow. So, thank you guys so much for watching. If you haven't subscribed, go ahead and do so. So it keeps me hyped up to make videos. Thank you guys so much, and I'll see you guys tomorrow with another update. Take care.